Hi guys, it's Shaftman from Shaftman TV. Today we're going to look at whether cash is actually king. So it's often bandied around, cash is king, cash is king. And fundamentally, it's not true. Okay, cash is not king. Okay, because cash is a bad investment. Over time, inflation eats in to the purchasing power of cash. So it's not king. If you hold excessive amounts of cash and don't have investments and assets, then over time you'll become poorer and poorer. Generally speaking, over time, with assets, you're going to become a little bit richer every day. If you own a commercial property for 30 years, every day you're going to become a little bit richer. If you hold the money that you would have used to buy the commercial property, every day you become a little bit poorer. So it's really important that investors understand that owning assets that produce cash is far better than just having cash. Now, it is a bit more nuanced than that. Basically, cash is the best insurance policy against the vicissitudes of the market, against mistakes. Maybe you unfortunately have some health issues you need to pay for, or you're out of work or whatever. Cash is the best insurance policy. If the market goes down and you've got cash, assets are on sale, it's a great position to be in, to have ready available cash to buy assets with. But generally speaking, cash is not king, because over time, the stock markets generally over a long enough period of time are going to go up. Now, I read recently that over a 19-year period, assets always beat cash. Now, I can't remember where I read that or in what context, but I understand the ramification of that data, and it's the same with, say, the stock market. From memory, I believe that the FTSE 100 in 1980 was about 300, something like that, if that's from memory, and now it's kicking sort of between sort of 7,300 to 7,500. It's recently hit its all-time high on a number of occasions. So generally speaking, if you would have placed that money in 1980 into an index fund and had the dividends, it would have absolutely beaten holding that requisite amount of cash. Or if you'd bought yourself a house in the 80s, in 1980, and you held it today, that would definitely have beaten cash. So it's really important. Obviously, I'm not saying don't have any cash in the bank, and as I've said previously, it's not a good idea to just have no cash at all. But it's really important to be invested, and this obviously fits in with a saying I really like, which is, it's not about timing investments, it's about the time in investments. Now, to time investment is really hard. It's very hard to do. We all hope we can buy a share at its 10-year low and sell it at its 10-year high. That's obviously the dream scenario. But where investors make money is by either buying the market or having, being invested over a long period of time. And over time, the assets, if they're good assets, will generate more money, and your share prices will go up, or your rental income will go up. So, it's really important. And also, like, another point to bear in mind is that cash at the moment, I mean, the rate of interest in most countries is negligible. It definitely, the rate of inflation is definitely higher than the rate of interest in most countries. So as a result, you're losing money. The purchasing power of your money is going down. I mean, in the UK, for example, between 1975 to 2005, the average rate of interest was 8.9%. In about 1981, the rate of interest was 16%. Now, in that context, assuming that inflation isn't above that, then it's pretty wise to hold cash and put it in to a savings account which generates interest. But at the moment, the rate of interest looks like, and I'm not an expert on the rate of interest, and I'm like, I won't make a prediction about where the rate of interest is going to go, but it looks like the rate of interest is going to stay low for a long, long time. Now, there's many reasons for that. It's called peak savings. There's it's reasons around quantitative easing, and China's rise, all that money in Chinese state banks, from all the exports through the 90s and the noughties, that was then lent out to European institutions and to companies in the United States, etc. And there's obviously general supply and demand. There's like an oversupply of money, so that's what has meant that the rate of interest has gone down. And obviously, they say that the grey, the people who are living longer, the grey pound or whatever, those people are living longer, which is a great thing. But people are, the people over 65 save money, and that's obviously, banks hold that money and then they lend that money out. So all these reasons, but it looks to me like the rate of interest is going to be lower for longer. So generally speaking, moving your money into assets is a wise thing to do, in my opinion. Obviously, not bad assets or bad investments. And by assets, I'll generally make my own definition, or not my own definition, but a definition that I think is accurate is an asset is something which generates cash flow. So I personally wouldn't think that gold is an asset. I think gold is a speculative thing. So like property, for example, if you were to buy a property and rent it out, hold it for 20, 30, 40 years, you will have the rental income, the post-tax rental income, and you're also going to have the value of that property, generally speaking, highly likely to go up. So, and again, it's not guaranteed, but generally speaking, that's what happens. There has been some examples of where there's been sort of stagnation, and Japan is a really good example of that. If you look at sort of from the 90s till now, the stock market in Japan, I believe, has halved in real terms. It's not giving a return to shareholders. So that it's not always going to be the case, but generally speaking, cash is not king, and assets will always beat cash. If you've got a farmland, or you have a business that generates a little bit more money every year, or commercial property, some residential property, an index fund with all those dividends coming into your index fund, and obviously, again, you need the insurance policy of having excess cash, but just really think about it, that over a long period of time, i.e. where investors make most of their money, cash is not a good investment. So, yeah, just something to think about, guys, and have a great day, everyone. Thanks a lot. Thank you.